Welcome back, viewers, to another ML forecast video. Today, what's the forecast for the 10-year Treasury bond yield? Will it go up or is it on the way back down? Let's find out using algorithms and machine learning models. Interest rates on savings accounts, money markets, and treasuries have finally been going up after hovering around 0% for years. The 10-year Treasury bond yield went up as high as 4.25% recently and is now around 3.5%. But the overall trend is up, as we can see on the chart. So what will happen next? Will it go back up beyond 4%? Or will it go down to where it has been in the past? Let's find out what the ML forecast models have to say. But first, what other key indicators impact or correlate with the 10-year Treasury? Our machine learning models include unemployment, inflation, and the Fed funds rate. The Fed funds rate is controlled by Chair Powell and the Federal Reserve. It is highly correlated with the 10-year Treasury at 0.91. It has been raised by the Fed last year into the 4+% range. We will be making this a part of our machine learning models. We will look at 4 models, all using data since 1962. The first model is the most basic moving average, where we use 20 and 50-day moving averages. The second model is the time series-based profit. We have 2 machine learning models. Linear regression is the most basic of these. The random forest model is more sophisticated. Both of these will include unemployment, inflation, and Fed funds data. Let's get to it. The basic moving average model would suggest a 3.6% 10-year Treasury yield. This is essentially flat to where it is today. Let's look at the more complex profit model. The profit model is a time series model, which means it does not consider other variables like the Fed funds rate. It is suggesting a 1.9% 10-year Treasury yield moving forward. We have this in red, since if you are a saver, then this would be a negative in terms of the rate going down this low again. Now let's move on to the machine learning models. The basic linear regression model. Here we are including the Fed funds data too, and we notice it is predicting a 5.5% 10-year in 2023, followed by a drop. We highlight this in green, since this would be a positive for savers. The R-squared score for this model comes in at 0.8616, so not great. Let's take a look at the random forest model. This is our fourth and final model. It's the most sophisticated of the 4. Here too, we use the correlated Fed funds data and the less correlated unemployment and inflation data. The random forest model predicts a higher 6.1% 10-year for 2023, also followed by a drop, albeit more precipitous. The R-square score for this model is high at 0.9931. Okay then. Next, let's summarize the results and see what, if anything, we can conclude. The moving average and profit models suggest steady or lower rates. The linear regression and random forest models both suggest a higher 10-year Treasury in the shorter term but lower in the longer term. The simple moving average model has the highest R-squared score. The random forest model has an almost as high R-squared score. So let's see if we can summarize our findings. So what is the ML forecast for the 10-year Treasury yield? Shorter term, or this year, we expect it to go up from the 3.5% today. Longer term will likely go down. If you enjoyed this video forecast, please like and subscribe to our channel. Also, please remember that this content is for entertainment and educational purposes only. Do not use this information for making financial decisions. For that, consult with a financial professional. See you next time.